Yesterday was like three news stories in one. We were sitting here early in the morning. We talked to our buddy Charlie Gasparino at Fox Business, one of Mizzou's finest graduates ever, of course. And we're getting ready for the markets to open up. And it's like, oh, man, these tariffs are coming. Markets are freaking out. Then a few hours later, deal with Mexico, or at least a pause with Mexico. And then in the afternoon, a pause on the tariffs with Canada. So it was quite a day yesterday, and we're happy to have on and welcome to KCMO Talk Radio Taylor Riggs, co-anchor of the Big Money Show, 11 o'clock Central Time on the Fox Business Network. Taylor, yesterday was quite a day, no doubt about it. Do you feel like the markets were, looking for drama and overreacting to all this at times?
Yeah, I see both sides of the story to this. So, Trump has been telegraphing this pretty much since November. So the fact that the markets did not take him seriously until yesterday showed me that they were indeed underpricing risk. That being said, in the morning, I think it was a big overreaction. Part of me is like, we're only down 1.5%. In the scheme of things, we get 1.5% declines every month. It's not that big of a deal. And I think more importantly, if we had seen the market really take him seriously and thinking that there was going to be serious tariffs for a long time, which the market expected to mean higher inflation, we would have seen yields on the long end of bonds rise. We did not see that. We saw the opposite. We saw yields fall on the long end. So I think the market was a little confused yesterday. They get the headline risk. Everyone gets nervous. Sell first, ask questions later. And then I think you're right. Once there was time to digest what was the actual news, is there a pause? We all had time and we rallied immediately and mostly closed about unchanged, but a little bit lower. So I think the markets need to do a little bit of a better job of reading through the tea leaves, listening to the president, taking him seriously, but also not doing this whole thing of you sell first and ask questions later. Mm-hmm. But if you did, there were some good buying opportunities. I was talking to a portfolio manager yesterday, and someone called him and said, NVIDIA is down 5%. And he was like, great, buy it. When's the next time NVIDIA might be down 5%? So again, there's sort of pockets of opportunity, but I think that my message, it's going to be volatile. Everyone buckle up.
Yeah. And I do think we have to realize, too, the headline is always like Dow drops 400 points. Well, with the Dow now sitting at 44,000, a 1% drop, it's not like it would have been when it was 15, 20, or 25,000. I think that some people forget that. They see the big number and it's like, wait, that's barely a percent. So I think that, for the people just looking for headlines, right? I feel like that conversation has to be recalibrated as well.
1,000%. I'm with you. I always look at the percent, and more I've been looking at the S&P 500 versus the Dow, and that's a broader gauge of sort of where America is right now. And when you get the percent, and again, a 1% decline, we get that every month. That's a nothing burger. So I think you're right to sort of calm down the audience. Let's look at the percent change. And then again, think about where you are in your portfolio. And if something is down big, like 5% or more, is that a buying opportunity? Or are you, not comfortable with what I think is going to be a very volatile year? And we're going to have moments like this more frequently. And then do you just want to, sit back and ride the wave?
So with that, Taylor Riggs is here, co-anchor of the Big Money Show, 11 o'clock Central on Fox Business. When we start kind of looking at the first few months of this administration, the changes that obviously are coming, what are the benchmarks, the things that you're going to be looking at to figure out if the economy on Main Street is getting back on track?
Yeah, I think a few things. First, we have Jobs Day on Friday. Now, there's been a lot of problems with the way that the data and the surveys have been collected. But still, for me, someone who sort of cut her chops reading and analyzing and digesting this stuff, I still look at Jobs Day on the headline and underneath the surface as just sort of a general gauge of employment in America. Then I think it's important to look at wages after inflation. So I think the biggest frustration with Biden is my take-home pay after inflation went down. I was poor because inflation outpaced any raise that my boss gave me. So I want to be looking at inflation adjusted or real wages. Those grew under Trump 1.0, and that's a measure of how I feel. Is the raise that I'm getting from my boss outpacing the rate at which prices are rising? If so, I'm good, right? I feel like I'm coming home with more money in my pocket. So I think those are some good measures. And then again, this isn't really something that we can control yet, but looking out on the bond market for yields, because if you think about that, it then impacts mortgages, credit card, auto interest rates, everything about that. So yields started to jump up to about 5%. That's why mortgage rates, 30-year fix, is still at 7%. If you want to start to see that come down, maybe if that helps with housing affordability, those are going to be some other benchmarks that I look at to feel like this country feels affordable again in all of those areas, interest rates included on the mortgages and the autos and the credit cards that we all pay.
And it's a fine line, right? Because Trump has said he wants to see the Fed start reducing rates, but you do risk that inflation picking back up if things like government spending isn't kind of gotten under control. So what is that fine line? I know the Fed obviously is meant to operate independently, but how do you see them navigating what you say is going to be a fairly tumultuous year when it comes to the ups and the downs and the swings?
Mm-hmm. Yeah, I mean, very difficult. I do not envy them. I would never want to be a Fed official. I think what they can control is if they cut interest rates, they only control that. But it is up to I'm going to bring in DOGE here, right? I mean, people are so excited about cutting the bureaucracy and cutting government spending. If you can do that, then inflation will come down. That is such a disinflationary force by cutting spending. That will bring down inflation for everyone. So again, that's in the power of the president and Congress on the fiscal side of things. The Fed only controls, as you know, interest rates on the short end and the monetary side of things. So I think for me, it is perfectly fine for the president and the head of the Federal Reserve to have conversations. But the Fed has made it clear that they won't be coerced into lowering rates just because that's what the president wants. We've heard that with Biden. We've heard that with Trump 1.0 and Trump 2.0. So they're going to have to be very careful. I don't think we would get any cuts before the second half of the year. I mean, we could easily be looking at June as this Fed kind of waits and see where inflation ends up.
Do you feel, and do the money managers you talk to privately, are they cool? Are they okay with DOGE slicing and dicing the bureaucracy, or do they like just the nonstop, incredible amount of government dollars flooding the system? Because let's be honest, it has been good for the markets.
It has been. But I also know that everyone I talk to is deeply, deeply worried about how we're going to pay for our debt and our deficits. So in the short term, if I'm the stock market and I run in 3-month increments, quarterly earnings here, quarterly earnings there, let me get to March 31, June 30, sure, goose me up all day. But if I'm sitting back as a portfolio manager and I'm planning generational wealth, I'm thinking about my daughter, who I have, other people's families, I'm thinking this isn't sustainable. So I think actually long term, money managers I speak to have never been more excited about people like Scott Bessent, who's running the Treasury right now. He's one of the smartest people ever. I mean, he built his life's work trading currencies. I mean, this guy is the real deal. DOGE, Elon Musk has been a massive disruptor. Love him or hate him, I think he's bringing to light a lot of things that people really have been frustrated with for a while. So long term, I think we have to, because the Fed can cut interest rates all day. But remember when they did, yields jumped a full % because they said, no, Federal Reserve, there's no amount of lowering interest rates that you can do that's going to make me believe that this country is on a sustainable debt path. I don't believe you. And that's a bigger problem. So I think long term, people actually really are excited about DOGE. You have to tackle this problem because eventually, not tomorrow, but 5, 10, 20 years from now, this is going to be a massive issue.
Last thing, Taylor Riggs, and absolutely spot on there with that as well. Right now, I saw this yesterday, the top 10% largest U.S. stocks reflect a record 75% of the U.S. equity market. This percentage has surpassed the previous record set before the Great Depression. During the dot-com bubble, the percentage was 73%. How concerned are you by how top-heavy the market is right now?
You know, I am not as concerned. I agree that you want for a healthy market rally, a broad-based, everyone participates. That being said, this is very, very different from .com. The AI companies that are leading the market cap, Google, Alphabet, Meta, NVIDIA, Tesla, you name it, these are real profitable companies. In .com, you had all of these people who were just adding .com to their name, and they had no business, and there was no profit, and there was nothing. It was sort of like a whole shell. This is actually real companies making real things, making real money that are using AI to change the world. So I give them a little bit more grace than I did in 2000 in terms of the weight that the market has placed on their shoulders, if you will, because I think these are actually revolutionary companies that are in the beginning of what could be $1 trillion AI opportunity.
Wow. Well, we'll see. It's going to be really interesting next few months. Taylor Riggs, watch her today, 11 o'clock Central, co-anchor of the Big Money Show on Fox Business. Thank you so much, Taylor. Really appreciate it.
Thank you.
Have a great day. You as well. Taylor Riggs on KCMO 95.7 FM.